Thank you. Thank you, Mr. Chairman. Today, as the chairman has indicated, our committee is examining the need to establish a systemic risk monitor that might have helped to prevent the financial crisis that our nation now confronts. And I will stick with the term systemic risk monitor rather than macro-prudential regulator. America's financial crisis has spread from Wall Street to Main Street, affecting the livelihoods of people all across the country. The American people deserve the protection of a new regulatory system that modernizes regulatory agencies, sets safety and soundness requirements for financial institutions to prevent excessive risk-taking, and improves oversight, accountability, and transparency. Our financial regulators should have had the ability to see the current collapse coming and to act quickly to prevent or mitigate its impacts. Unfortunately, oversight gaps in our existing system, risky financial instruments with little or no regulatory oversight, and a lack of attention to systemic risk undermined our financial markets. When the entire financial sector gambled on the rise of the housing market, no single regulator could see that everyone, from mortgage brokers to credit default swap traders, was betting on a bubble that was about to burst. Instead, each agency viewed its regulated market through a narrow tunnel, missing the total risk that permeated our financial markets. When the housing market collapsed, the impact set off a wave of consequences. Borrowers could no longer refinance their mortgages. Credit markets were frozen. Consumer demand plummeted. Businesses were unable to make payments or to meet payrolls. And workers were laid off, making it difficult for even more families to pay their mortgages. In Maine, the unemployment rate has reached a 16-year high of 7% at the end of 2008. There were also more than 2,800 foreclosures in my state. Not that many compared to other states, but nearly a 900% increase from the previous year. This financial crisis has harmed virtually every American family. Taxpayers have financed bailout after bailout of huge financial institutions at the cost of trillions of dollars. These drastic and expensive rescues might not have occurred had there been a regulator evaluating risk to the financial system as a whole. Such a regulator could have recognized the house of cards being constructed in our financial markets. While there are certainly many regulators at both the federal and state level, not one of them had the ability to evaluate risk across the entire financial system. For example, the Federal Reserve could clearly see the large number of securitized mortgages of banks within its jurisdiction, but it had virtually no visibility into the full extent of securitization at non-federally regulated banks or financial institutions under the purview of the SEC. What was needed then, and is needed now, is a systemic risk regulator. The GAO and other government and industry officials, as well as academic experts, have called for the creation of such a monitor. But as the chairman indicated, the creation of a systemic risk monitor raises many new questions about its structure and authority. Should it be an existing regulator, such as the Federal Reserve, that is charged with monitoring systemic risk, or should an entirely new entity be tasked with that responsibility? My belief is that we should establish a council composed of the heads of our nation's financial regulatory agencies that could be an interagency task force. We must also consider what should occur when systemic risk is detected. Should a systemic risk entity be empowered to issue its own regulations, to review and approve new financial instruments, and to fill the regulatory black holes that result from overlapping or narrow agency jurisdictions? Or should the monitor be required to work through existing regulators? In designing a better regulatory framework, we must take care not to create a moral hazard by implying that this entity exists to make failure impossible. We must also take care not to stifle the creation of innovative, useful new products, nor to prevent beneficial risk sharing. The challenge is to ease the turmoil caused by failing but important institutions without setting off a cascade of trouble for otherwise healthy entities. In other words, we need a better system to prevent the development of catastrophic concentrations of risk at firms like Bear Stearns and AIG, and better systems to mitigate the collateral damage if they do fail. Our goals must combine several vital objectives: stability for the financial system, safety and soundness regulation for institutions, protections for investors and consumers, transparency and accountability for transactions, and increased financial literacy for the public. Significant regulatory reforms are required to restore public confidence and to ensure that a lack of regulation does not allow such a crisis to occur in the future. In fact, I would contend that one reason why we have not seen a stabilization of our markets is because the public continues to lack confidence. And one step that we can take that would make a real difference is the creation of a stronger, more effective regulatory system to help restore that confidence. And that's why the set of hearings that the chairman has initiated are so important. Thank you, Mr. Chairman. I look forward to hearing our witnesses.